It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me at yourpersonalbank.com. So Bank of America recently posted S&P 500 valuations. It turns out that they have 20 valuation metrics that they use. And as they posted, as the end of September of 2025, that 19 of the 20 valuation metrics they track, the index, the S&P 500 index, that is more expensive than the historical average. Now, a number of these tracking metrics are not only higher than historical averages, but well over, like significantly over the historic averages. And these go back all the way back to, say, 1900 to present. It is really shocking when you look at it and all the metrics that they use and how they measure the valuations where they're at in the S&P 500. And this is why I've often shared on this show recently that almost regardless how you measure the S&P 500, we are at the highest levels ever seen in the history of the stock market, which does include 1929 and 1999. So that's where you want to put yourself in perspective where we're at right now. Understand we are at all-time historic levels of valuations. Another one of the indicators that I've often referred to and like to use is called the Buffett indicator. Now, the Buffett indicator is famously attributed to Warren Buffett, and it basically takes the value of the entire stock market, all the valuations of all the companies compared to GDP or gross domestic product. At 200, you're double the average. And he has often stated anytime over 150, you're pushing it. Well, we are now at 217%, according to the Warren Buffett indicator, which is the highest levels ever recorded. The other issue that's going on is leverage. And leverage is where a lot of people purchase, or institutions will purchase stock on margin. In other words, they'll borrow money to buy stock. Obviously, when you do that, that does increase overall risk, especially to the downside, because when the markets move and the valuations, say, move quickly, a person could get what is called a margin call, because the value of the stock that they bought on margin or borrowed money for goes below the level of what's been borrowed, and then the broker will require them to pay that back. That's why it does tend to increase volatility when margin debt is elevated. The level of margin debt we're looking at currently is at all-time high levels. And it's no secret that AI bubble fears are in the rise. A record of 33% of fund managers now say that the biggest tail risk to the markets is an AI equity bubble. Now, what is a tail risk? Well, it's what they define as a rare but extreme event that could cause massive market losses. This is the type of shock that reshapes market valuations and sentiment. Think 2008 or 1999 or 2000, the dot-com bubble bursting or the Great Recession. Those are the types of moves that do reshape market valuations and overall sentiment on the markets. The current situation we're in with the AI bubble has nothing to do with valuations or PE ratios or earnings or any other measurement you really want to look at. It really has to do with emotion. Emotional decisions are being made, and it's the basic human emotions of fear and greed. And these are very, very powerful emotions, hard to overcome, hard to ignore, and hard to predict. Obviously, greed, or what you may call fear of missing out, is currently dominating the markets, and that's where we're at, why the S&P is at such elevated levels. Given that we're at historic levels that have never been seen, there's no way to measure this to any type of norm or any type of logical financial measuring tool you want to use. So the movements of the market now are dominated by emotions, and emotions are tremendously difficult to anticipate or predict. And that's why movements that are based on emotion, whether it be fear or greed for that matter, can often be very volatile, very aggressive, and very fast. The mood or sentiment, as they like to call it, can shift almost literally overnight. It can happen quite quickly, or a cascading effect, if you will. So that's what I'm saying. Understand that where we're at, I'm not saying not to invest in the market. Please understand. And I'm also not saying that AI is not a technology that's going to fundamentally impact our economy in a positive way. I believe that it will. But what I also believe is it's not in the time frame that the hype or the current valuations, where the current valuations are at right now. There's no logical way or financial way to measure it. So again, it's based on emotion. And I think a lot of people are going to get hurt, and I think a lot of people are going to get burned. And I'm not the only one feeling that. A Reuters article recently pointed out that opinions are now split over the AI bubble after billions have been invested. As they say, companies announcing multi-billion-dollar investments in AI have raised concerns about the formation of a bubble reminiscent of the dot-com boom and then later bust. And this is why investors are on guard for signals that either demand is tailing off or the massive spending is not paying off as anticipated. And a Bank of America Global Research monthly fund manager survey revealed that 54% of investors said that they thought that the AI stocks were in a bubble, compared to 38% who did not believe that a bubble exists. Now, if I had looked at this just even a few months ago, those numbers were completely reversed. So clearly the sentiment or the overall perception of whether we're in a bubble or not by fund managers has shifted pretty extensively, pretty quickly. The Bank of England recently came out and stated global markets could tumble if investors' moods sour on the prospects of AI intelligence. The Bank of England's Financial Policy Committee stated the risk of a sharp market correction has increased. Jeff Bezos, founder of Amazon, recently stated, when people get very excited, as they are today, about AI, every experiment gets funded, and investors have a hard time, in the middle of this excitement, distinguishing between the good ideas and the bad ideas. The International Monetary Fund's chief economist stated recently that the AI investment boom may be followed by a dot-com style bust. And he said if there is a market correction, some shareholders may lose out. Sam Altman, OpenAI CEO, who's in the middle of all this, recently asked a question, are we in a phase where investors as a whole are overexcited about AI? My answer is yes. Someone is going to lose a phenomenal amount of money, and we don't know who yet. And Lauren Taylor Wolfe, who's co-founder of an activist investment firm, Impactive Capital, in a recent interview I thought was quite interesting. She stated, we're absolutely in an AI bubble now, and it's going to burst. I don't know when. I don't know the order of magnitude. A lot of people are going to lose money. She also went on and stated there are trillions of dollars being earmarked to be spent relative to hundreds of billions of dollars of free cash flow. This means these companies are going to have to borrow to invest in all of this AI infrastructure, and we have yet to see the returns on investment. She finished off by stating, show me trillions of dollars of profits that are going to be generated in the next 5 years. And you just can't. The math doesn't work. Too much expenditure is going into this to justify a profit. Other article I like from New Scientist pointed out that the AI bubble is heading towards a bust, but it won't be the end of AI. I believe that to be an accurate statement. And it went on and pointed out that economists, bankers, and even Sam Altman, the CEO of OpenAI, are warning of a rapidly inflating AI bubble. They go on and state hundreds of billions of dollars are being spent on AI. Seems to have created a global financial bubble that's now fit to burst, which will leave companies and investors at risk of holding vast debt that cannot be serviced by the meager revenue brought in by current AI services. They go on to say, but what does this mean for the future of the technology? it really follows the same point I've been sharing on the show for quite some time. And it is somewhat reminiscent of the dot-com boom and bust that we saw. The promise was that the internet was going to fundamentally change the economy, and it did. But unfortunately, not till about a decade after the run-up or the hype, or what many investors believed, there was a lot of delays, disappointment. There was many investors lost a lot of money before the internet actually, the technology, took hold and started to fulfill the promise or the hype that had been occurring in the late 90s. As this article points out, and I believe to be quite accurate, I think we're going to see a similar type of cycle of a boom and a bust, and then the technology will eventually start to catch up to its hype, and at that point, it'll start to make a real difference. Now, if you don't want to get caught up in this cycle, and many of you are unwittingly, which I'll share in the next segment, I'm going to encourage you to pull back from some of that risk. Contact me at yourpersonalbank.com, and I can share with you how to continue to receive unlimited upside gain. So if this continues, you can benefit from it. But if it does reverse and the bubble does burst, you won't get hurt by it. So stay tuned in the next segment. Don't miss it.
This is Ferenc, host of the Your Personal Bank Show. Great news. Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So this unprecedented increase in valuations in the S&P 500, in the tech stocks, etc., has caused an amazing, a historic even, concentration in the S&P 500. And this is where the risk is, where many people don't even realize they are being subject to that risk. And here's what I mean by that. Many people who are invested in the market will invest in different mutual funds or ETFs or baskets of stocks, indexes, various tools like that. And many of them have different positions that they will hold. But often what you'll find is many a times this overlaps. And if to use a simple example, let's say you own an S&P 500 ETF, for example. And normally you would think, well, I'm diversified. I'm invested in 500 different companies. Reduces your overall risk. Some things go up, some things will go down, but it kind of averages out, right? That's the whole point of diversification. Well, what's happened is the top 5 companies in the S&P 500, which are the tech giants, now represent about 30% of the S&P 500, which really skews the whole diversification point. And although if you were invested in that, and we've seen some tremendous returns over the past couple of years, the vast majority of the growth in the S&P 500, for example, has been with a handful of companies, 5 to 10 companies. Because the growth has been so stupendous, historic even, a larger percentage of the monies you have invested in these indexes, in these mutual funds, in these various financial tools has now skewed heavily towards these handful of companies because they've dominated and grown so much. So what's happened is if you kind of set it and forget it, which many people do, they don't even realize now how much exposure they really have to the AI bubble. And this is one of the main concerns we're now starting to see from a number of market experts, economists, etc. Whereas I stated in the previous segment, many institutions, experts, economists, investors, you name it, are increasingly warning about the fact that we're in an AI bubble and that it's likely to burst. And this is a historic one. This is 17 times bigger at this point, bigger than the dot-com bubble was, 4 times bigger than the mortgage bubble was in 2008, before that burst, which led to the Great Recession. Because there's so much of a concentration in these particular stocks and these companies, in so many of these ETFs and indexes and mutual funds and etc., if you just set it and forget it and you haven't looked at it very much in the last couple of years, a much higher percentage of your portfolio is likely invested in these companies than you may realize. Again, just the top 5 companies alone account for about 30% of the S&P 500. That's historic levels of concentration. Also, at the same time, we have historic levels of concentration in Americans' net worth. Latest studies show over 50% of the Americans' current wealth is in the market, and a high percentage of that is in the AI-related stocks. So what the concern is, and what the worry is because many people put this in, they automate it, set it and forget it kind of thing, IRAs, 401ks, retirement accounts, brokerage accounts, EFTs, mutual funds, you name it, all these things being historically concentrated. And if you haven't paid that much attention, and frankly, most people don't, if you're listening to this show, you're probably in the top 5% of folks paying attention to what's going on. It still shocks me how often I talk to somebody. This happens to me literally on a weekly basis. Somebody who has investments, and I'll point out that the S&P 500, for example, is at the highest levels ever recorded, including 1929, 1999. And they're surprised by that. They had no idea. What I'm getting at is most people don't pay that close attention. They invest for the future, but they kind of live their lives. They set it and forget it, automate it, which generally speaking is a good idea. That's how you build wealth over the long term, typically. But it is shocking how few really pay very close attention or much attention at all, so they have no idea. So the vast majority aren't going to understand this. And then when the correction occurs, when the bubble does burst, they're going to all of a sudden see dramatic shifts or dramatic changes in their account values. And they're not even going to really even understand why, because they're going to think to themselves, well, these high-flying, high-tech AI stocks, that's one thing. I'm more diversified. I'm more conservative. They don't even realize how much they're really in it because they haven't reallocated or readjusted, haven't paid that much attention. And then many are going to panic. Fear and greed. Remember, emotions will take over. That is human nature. You will not get away from that. Human beings don't change, ironically. To give you an idea of how historic concentration is in the markets, is the information technology and communication stocks now reflect 45% of the total U.S. market cap, all stocks basically. And this percentage, by the way, has doubled over the last 10 years. And the last time any industry had any kind of dominance where it had 45% of the total valuation of the markets was the transport sector in the 1880s. That's when they were building railroads, folks. That's how long ago it's been that a certain sector of the economy has dominated to this level where it's nearly half of the value of all stocks that exist in the market. So this is the type of concentration nobody alive has ever seen or experienced. And this is why there's becoming an increasing level of concern for when that bubble does burst, when that correction occurs. I remember the days of the dot-com bubble bursting and the Great Recession. Those were dramatic. The NASDAQ from the dot-com peak, top to bottom, dropped 78%. The 08-09 Great Recession drop, S&P top to bottom, was 55%. Those were aggressive, jarring emotionally. I would meet with people who were nearing or retired that would not open their mail because they didn't want to look at their account statements. Now, I always say that's no way to live. But you want to talk about stress? Because these are people that had invested money typically throughout most of their entire adult lives. They had built retirement accounts, etc. And they were watching it disappear. And they were not in a position in their life where they could do anything they couldn't replace it. They were retired in many cases or nearing retirement. They had to go back to work. There was a very distinct, I remember, situation where I met with a client we had rolled over a number of his IRAs into annuities with unlimited upside potential, no downside market risk. About in 2007, actually, it occurred. And I was doing a review with him a year or two later. The markets at that point we were seeing between 20 and 40% drops over the previous year. He did this when he retired. He was an engineer, very analytical, and understood reducing risk made sense, particularly when you're moving into retirement or are retired. And as I pointed out to him that his accounts had not lost any money. He had maintained all the principal because, again, the principal is guaranteed. And so he was perfect. He was fine. And he was taking income off of it. Everything was great. And, of course, they continued growing for years after that. But I remember him making a statement to me. He'd been retired for about a year. And he said, everybody else I know left their monies in the market, and most of them are now going back to work because they were similar age to himself. He says, you know what we're planning to do after this meeting? I said, no. He says, we're going to go play tennis. That was a poignant reminder of why reducing the downside risk is so important, particularly when the risk is elevated like it is now, when you're at historic highs, and also at time frames in your life where, say, you're nearing or are retired, and you don't have the time to recover from that correction. And I've shared this in previous shows, but how long does the average correction take to come back? It's about 5 to 15 years. You can look at all the different corrections out there. The shortest was about 18 months, and the longest was like 25 years. That was the Great Depression. But the average is around 5 to 15 years. Great example, again, the dot-com. If you were in the NASDAQ at the peak, dropped 78%, took 15 years for it to come back to even, which means you made no money during that 15-year period. You just recovered what you previously had held. In 2008, the S&P 500 famously dropped 55% top to bottom from that bubble and then later Great Recession, and took 5.5 years to recover to get back to even, which meant, again, you made no money during that 5.5-year period. You just recovered back what you had held previously. People are looking at this and they ask me the question. I just ask them I ask them a very simple question. If the market corrects, do you have 5 to 15 years to wait for it to come back? If you're young, the answer might be yes. But if you're not so young, the answer may not be yes. It's probably no. As the older you get, the less time you have, right? Most people I talk to, they're usually, of age where they're maybe 50, 60, 70, whatever, anywhere in those ranges. That's most common. I do have clients that are 18 and I have clients that are 80. But let's say somewhere between late 40s to mid 70s is like the most common. And most of those people don't have a decade, 5 to 15 years to wait just to break even. Remember 2000 to 2010 was kind of known as the lost decade? That's where that came from. JP Morgan recently came out with a dot chart that was very interesting. And what they did is they took annual returns of the S&P 500 and then the following 10 years, what the average returns were after it had accomplished returns of anywhere from, negative to plus 20% plus. And here was what was interesting. after a period of time that we've seen recently, where we've seen 20+% returns in the S&P 500 multiple years, do you know what the average annual return was for the following decade every single time? The range was 2% to the high side to -2% on the low side. In other words, according to JP Morgan, going back and studying every previous example of the S&P 500 having tremendous returns, the following decade, once the correction occurred, the average return was basically nothing. Again, between 2% to -2%. Now, it's not guaranteed that's what's going to happen, but it has every single time previously. So if you are invested in the S&P 500 or various stocks or investments or ETFs or mutual funds or whatever, when this current cycle ends, we're in the late stage of a bull market. I don't think anyone would argue that point. Are you prepared to see probably little or no gains for the next decade? In fact, what typically happens is you have a correction, it drops, and then it has to recover, and on average, it takes about a decade to get back to where it was, which means, again, you had a lost decade. Are you prepared for that? Would you like to avoid that? How would you like to continue to receive unlimited upside gains while at the same time protecting your downside? Well, index products will do that. Index annuities, index life products will do that for you. And yes, we are seeing people receive 20+% returns in the recent years because the S&P, for example, returns have been incredible. But the best part with these products is once you get the gain, once you lock it in, that becomes your new principal, and you can never go backwards from that point. You lock the gains in each year. My question is simple. Why continue to put assets at risk, investments at risk, when you can protect those gains, continue to receive upside while protecting the downside, locking those gains in? If you want more information on it, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got a few things, some points about the AI technology that I think you'll find very eye-opening.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So the fears and concerns about a AI bubble are increasing by the week. And one of the reasons that we're still finding people stating it's not a bubble, no matter how you measure it, we're at historical high valuations, is that there is a lot of money on the line. You see, if you continue to pretend that generative AI is just around the corner, you know there's over $1 trillion of investment riding on this belief. You had worked hard to create those deals, to generate that money and generate that investment. You know, it could easily all come crashing down if people thought that, hey, it's just not right around the corner, generative AI. It might take another 5 or 10 years for it to actually happen. Most of that investment, those investment dollars, would dry up, wouldn't they? It only makes sense. And if you really look at it, I mean, these are supposedly really smart people, but I think they're caught up in a bubble, so to speak, even within. And that's not uncommon. Again, that's human nature. You can get even very intelligent people get caught up in hype, especially if they're like Silicon Valley in a bubble around each other. It kind of reinforces your belief system, if you know what I'm saying. Yeah, we all seen this politically, where you have, depending on who you listen to, what media you listen to, and who you hang around with, you're going to have very different beliefs about the current political situation. That's no secret with anyone, right? So it's easy to live, especially in today's day and age. It's ironic, we're in the information age, but yet because of algorithms with social media and all the things that are going on, it's amazing how much you can be insulated in a bubble, far more than most people realize. You have to take really active steps to get outside of that bubble, and it's actually gotten harder. It's become much more difficult in today's day and age than it used to be. You know, if somebody lives in a large blue city, let's say, in a career or job position where there's a lot of other like-minded people, and they're on certain social media, they're probably not going to hear much outside of that, what everybody else thinks. Where you take another person who lives in a very rural area, maybe they go to church, they go to the gun range, their friends, the people they hang out in, the social media that's being fed to them is very, very different. It's amazing how different it is when you really look at it. Well, you can see the same thing with finances, investments, all that. And I think a lot of that is going on. Again, this is human nature. It's not about intelligence, it's about emotion. And emotions are really powerful things. But if you look at the math, if you step back a minute and you just look at the math, the amount of current and recent capital expenditures, the amount of money that's going into building the infrastructure just can't be justified by any current use cases or technology. I mean, current spending is at about $10 to $15 to make $1 profit. Now, I'm sure that'll get better over time, but man, that's a big, big amount to overcome. Also, it's going to have to happen really fast, because it turns out many of these data centers literally depreciate either through obsolete, the chips, they come up with new technology all the time. These things get out of date, literally in 3, 4, 5 years, or overuse, they kind of get burned out, if you know what I'm saying. So this build out and then the profitability to break even is going to happen in the next 3 to 5 years. And the math doesn't work. If you just sit down and look at it and pencil it out, it just doesn't work. This is why recently Microsoft has now come out stating they're worried that OpenAI's rapidly escalating computing demands will lead to overbuilding servers that may not generate a financial return. OpenAI's co-founder even stated it'll take a decade before AI agents actually work. Andrej Karpathy, I believe that's how it's pronounced, again, AI's co-founder, recently did a scathing interview about the state of AI. He pointed out that he was not impressed with the state of AI agents and that functional AI will take about a decade. He's not impressed. He said they just don't work. They don't have enough intelligence. They're not multimodal enough. They can't do computer use and all this stuff. They don't have continual learning. I found this quite interesting when I was reading that. He's reading this. He stated, you can't just tell them something and they'll remember it. They're cognitively lacking and it's just not working. And it'll take about a decade to work through all these issues. As he points out, he's not negative to AI. It's just he's negative to the hype. He points out, when I'm at a party or a group of other AI investors, I'm 5 to 10 times less enthusiastic than they are. This is the co-founder of OpenAI, all right? So this is a credible source. He goes on and points out that currently, every time an AI performs an action, there's about a 20% chance of error. If an AI agent needs to complete 5 actions to finish a task, it's only a 32% chance it gets it every step right. Andrej Karpathy, again, who ran AI for Tesla and worked twice for OpenAI, helped co-found it, actually. said agents aren't anywhere close. He pointed out they're about a decade away. He discussed how about AI slop. He points out the models are not there, and he says, I feel like the industry is making too big of a jump and is trying to pretend that it's amazing, and it's not. It's slop. And he says, I think we're not coming to terms with it, and maybe we're trying to fundraise is why. I'm not really sure what's going on. They lack intelligence, can't use computers, and lack continual learning, and forget what you tell them. I was shocked when I heard that. Those were problems that AI has, and it kind of makes sense why it creates a lot of words or it creates a lot of content, but as many people are starting to point out, it's really just kind of work slop. And researcher Hyperbolic Lab CTO Yu-Chen Jin explained, at first I thought Chat GPT-5 had cracked some math problems on its own. It just turned out that it looked up the answers via a web search. So it really wasn't thinking, it was just providing information that he could have found online if he had just done a Google search. In one of the most disturbing AI papers that came out recently, several scientists proved that large language models can literally rot their own brains, the same way humans get brain rot from scrolling junk online content. They fed models months of viral Twitter data, short, high-engagement posts, and watched their cognitive collapse. Reasoning fell by 23%. Long context memory dropped by 30%. Personality tests showed spikes in narcissism. And even after retraining on clean, high-quality data, the damage didn't fully heal. In other words, garbage in, garbage out. Turns out that large language models, when you boot them up, they always start from zero. They don't remember anything from previous. And they're good at imitation, but terrible of going off the data. They've got too much memory, but not enough reasoning. They memorize perfectly, but generalize poorly. So if you give them random numbers, they can recite them back, which no human can do. So it looks impressive. But humans actually forget just enough to be able to find patterns. AI cannot do that. And anything that's truly new, ideas that have no template, they just stumble. As they pointed out, AI currently is still just autocomplete engines with perfect recall, but no understanding. So the comment is they're still brilliant mimics, but not thinking minds. So these are comments from the experts that I'm no AI expert. I will not pretend to be. But these comments from the experts are alarming. And I believe if more and more people realize this, which they will eventually, that's maybe what will cause this bubble to burst. There's a few other reasons that may cause it also, which I'll share in the next segment. If you want to continue to receive unlimited upside potential gains with no downside risk so you can protect yourself from this, contact me at yourpersonalbank.com. We have index annuities, index life products that will do that for you. Very powerful tools. I'm going to share with you the next segment a few reasons why or what may cause this current AI bubble to burst.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So in the last segments, we were discussing how the valuations, I know I've been repeating myself for the last several weeks, but it can't be said enough. The historical levels that we are at are numbers and valuations that have never been seen before, ever, in the history of the stock market. This includes periods of time like 1929 and 1999. I keep repeating this and pointing this out because I still run into folks literally every week that have no idea and are actually shocked by this. Mostly because they don't paying that close of attention and don't realize how far things have gone up and how much the risk is elevated. We also have the historic concentration of both the amount of companies, which are very few, that are producing these historic returns, which means if you were in an index fund, let's say an S&P 500 indexed fund, that about 30% of that fund is actually tied up in just 5 companies. That's it. So diversification has pretty much gone out the window if you haven't reallocated. Over 50% of current wealth is tied up in the stock market for the average American. So when you put all those things together, the historic valuations, the historic concentrations of the companies, and the historic concentration of Americans' wealth tied up in all the same thing, this elevates risk to levels we've never seen before. And that's what I want people to understand. Elevated valuations and extreme concentration will likely create future volatility and significant risk to the downside. And folks, it could be really, really volatile. It could be really aggressive, shocking even. I want you to be aware of this. At least if you are invested, at least understand the risks that are involved. Also, I want you to understand that you don't have to expose yourself to this type of risk, yet you could continue to benefit from the upside gains if they continue. Index annuities and index life will provide those protections for you. Unlimited upside growth with zero downside market risk. They guarantee the principal. If you can lock in some gains, or you don't want to put yourself in that level of risk, why would you not? And the one objection or question I'll get oftentimes, if somebody has seen significant gains, is they're concerned about capital gains taxes. I shared this last week's show where there's a number of ways to reduce or mitigate those taxes, depending on your income and various factors like that. If you want more information, contact me at yourpersonalbank.com. What's likely going to cause this AI bubble to burst? Well, it could be any number of things, really, and no one is going to know until after it happens. There'll probably be a number of head fakes. We'll see some drops, some reversals back, a lot of volatility before a true correction or crash even, like we saw in 2000 or 2008, do occur. Now, one of those I'm not hearing very many people talk about is there is another competitor out there who's significant in AI, and that happens to be China. And China has taken a different tactic than the U.S. is. The U.S. companies are building massive infrastructure to create massive amounts of computing power to get AI to the next level. And is that the right direction to go? Well, that remains to be seen. China's taken a different tactic. They're looking at how they can make it more efficient. And it turns out DeepSeek, which is a Chinese AI company, is continuing to show how to win with AI by working smarter instead of piling on more brute force computing power. Alibaba Cloud claims to slash NVIDIA GPU use by 82% using a new pooling system. Now, I have no idea what the pooling system is. This article goes on and explains it. But the bottom line of it is this: it's more efficient. Now, how much do I believe coming out of China? That's debatable. But I think it's pretty clear China's taken a different approach. And if they do find more efficient methods to advance AI, that would completely destroy the huge build out that we're seeing with these data centers, for example. That would be massively negatively affect the handful of companies that are building this huge build out and are the source of the huge growth in the stock market, the S&P 500, etc. And this other article I thought was really quite interesting is artificial general intelligence the right goal for AI? And their point is they believe that a general all-purpose type of AI, like these large language models that we're seeing with like Chat GTP, are kind of a waste of time right now and should not be the near-term goal. That's something that probably likely will be available the next 5 or 10 years, efficient and effective, and not create so much work slop like we've been discussing before. Their point was, and I thought it made a lot of sense, that general purpose AI is like throwing spaghetti at the wall and hoping that, it sticks, or some of it isn't truly terrible. They believe that some of the areas where AI really shines is in concentrating on narrow, specialized AI tools engineered for particular problems. Again, I've said this before, I'm no AI expert, but I have done a lot of research on this and have listened to a number of interviews, read articles from a number of experts, and this seems to make more and more sense. AI is not good at generating new ideas. It's good at regurgitating existing stuff, but if you can narrow its focus down to something very specialized, that does seem to be an area of where it could really shine, particularly now, and then build out something more general in the future. And I think a real glaring statement in terms of, are we in an AI bubble, and is this all likely, gonna come crashing down on us, is the CEO of NVIDIA, who's been the biggest benefactor of this whole AI bubble, has recently been dumping tons and tons of NVIDIA stock. In fact, he has sold over $250 million worth of NVIDIA stock over the last 3 weeks. Now, there may be a legitimate reason behind what he's doing that. Maybe he wants to go buy a massive yacht or something. I don't know. But that's not a good look when the CEO of the leading company, the poster child, the one company that, if any, are making profits, because they're the picks and shovels. NVIDIA is creating the computer chips that all these companies are building out these data centers for, right? So these other companies, these data centers, think of them as the gold mines. They're digging for gold, right? And they're hoping they hit it. But NVIDIA is providing the picks and shovels. Well, if you go back to that same analogy, in most cases, who really made the money? Who made the profit in the gold rushes? It was usually the merchants that sold the tools, like the picks and shovels. Yes, some gold miners became rich, but most of them went bust, didn't they? Well, if the guy or the group, the company that's selling the picks and shovels is selling out like crazy, maybe he sees something on the horizon that, hey, maybe this whole thing's going to come crashing down pretty soon. I better get out while the getting's good. I don't know, but it's not a good look. I can tell you that much. The other reason I think that this whole AI thing may come crashing down has to do with just the general economy. As big as this AI bubble is, the economy is still bigger. And if you look at heavy truck sales, for example, the decline in the heavy truck sales that we're seeing currently has never been seen outside of a recession. And I've shared in last week's show and previous shows where, according to a Harvard study, that nearly all the growth in the GDP for the first half of 2025 came from the AI bubble or the AI companies building these data centers. So if that does slow down or even stop, that would certainly cause a recession because the rest of the economy is basically already in one. That's the only thing propping it up. And that's another thing. The entire economy is pretty much wrapped up in this AI infrastructure build out. You talk about lack of diversification and putting all your eggs in one basket. That's pretty much what our economy is doing right now. We're also starting to see U.S. employers have announced nearly 1 million job cuts in 2025 so far, which is the most since the 2020 crisis where, the government forced shutdowns of the COVID shutdowns, right? And then the third reason that could cause a AI or market correction, crash, whatever, the bubble bursting, has to do with debt. And it's both not only the government debt, but it's also consumer debt. In other words, the U.S. consumer is struggling, and the consumer may eventually break. About 50% of all consumer spending is now happening with the top 10% of income earners. So we're relying on a very small percentage of people to keep the U.S. economy going. And remember, U.S. consumer spending is about 2/3 of GDP. So you're talking about a small number of people that if they back off, or some of the lower middle income folks start to crack. In other words, they fall, they just can't keep going because the increased costs of everything. Those are kinds of things that could definitely cause this bubble, this cycle to correct, to even crash. We could even go into a recession. And it doesn't look like, in terms of housing, for example, that interest rates are going to get any better. Fannie Mae expected mortgage rates at the end of 25 and 26 to be about 6%. The reason is the bond yields are staying high, higher for longer. We've heard all these things. And there's even an economist now that's come out. He's stated that don't expect mortgage rates to drop much below 6% for the next several years. There's a lot of reasons behind this, but higher interest rates for longer typically is not good for a stock market or a real estate market for that matter. We're at historical levels, historical valuations. Volatility is likely to be the dominant factor going forward. A correction and even a crash is increasingly becoming likely. I don't have a crystal ball. No one does. We can't predict the date, the time, the length, the duration, the severity, none of those things. But we can identify the season. We know when risk is elevated, asset valuations are elevated, risk is elevated, that's when you scale back. And if you haven't done any adjustments recently, you're probably at more risk than you realize. You can continue to benefit from unlimited upside potential with no downside market risk with index annuities, index life. It's a golden age of fixed assets. Never been a better time in over 40 years to look at those products. If you want more information, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.